4 gigawatts, 20 years. Nvidia is talking like an infrastructure sponsor, not a chip vendor. A GPU inside a dark building cannot produce a paid answer. Nvidia's next growth problem is getting land, electricity, walls, servers, and customer demand to arrive together. For Nvidia shareholders, this turns a product story into a financing story. Can Nvidia bundle the site, power, factory, chips, and tenant into an asset banks will fund? And who carries the risk for 20 years? The 4 gigawatt clue points to the business Nvidia is really trying to build. At ports, Pike, Nvidia says it will support LPS infrastructure at roughly 4 gigawatts across a 20-year term. OpenAI is slated to build and run the AI factory there. The first deployment is expected to supply 4.25 gigawatts. Different layers, almost the same scale. That is not a normal chip order. The important product is the stack beneath the chip. A site must be usable. Power must be reachable. A building must accept the machines. Demand must last long enough for lenders to recover their money. Remove one layer, and the package stops being bankable. The announcement connects that site stack to an OpenAI-operated factory, with Nvidia supporting infrastructure. My read is that this is a handoff contract. Each party's promise makes the next promise easier to finance. The scarce unit is no longer a loose GPU. It is a working chain. That changes Nvidia's commercial boundary. Selling the accelerator captures one invoice. Helping coordinate the powered site protects the conditions behind many invoices. The company is reaching outside silicon because an accelerator waiting for electricity is unsold economic potential. The next bottleneck runs on a slower clock. The next constraint is not etched in silicon. It surrounds the chip. Picture the fastest accelerator in the world waiting outside a dark data center. The chip is ready. The grid connection is not. No customer pays for theoretical compute, so technical speed loses to site readiness. That is the mildly absurd bottleneck Nvidia is trying to remove. The chip clock rewards frequent upgrades. The site clock must coordinate land, construction, grid access, and long-lived financing. Those clocks do not naturally agree. A buyer can want more accelerators today while the place that will run them remains a sequence of unfinished dependencies. Follow one unit of capacity. Land gives the project a location. Electricity makes the location useful. The shell makes the power usable by servers. Accelerators turn that site into compute. A customer contract turns compute into expected cash. Finance works backward from that final promise. Nvidia sits near the middle of that chain, yet depends on every link. By helping align the links, it can make chip demand easier to deliver, steer projects toward its platform, and reduce the chance that a customer order stalls before installation. Coordination becomes part of the product. Financing is the next handoff. A $926 million loan shows how a pile of GPUs becomes collateral. Lambda said it priced a $926 million senior secured term loan for its GPU cloud expansion and customer deployments already under commitment. The headline is the loan's size. The more important detail is what lenders were willing to rely on when they supplied the money. Lambda said the loan would be secured by the funded GPU servers and supporting infrastructure, plus contracted cash flows. Hardware gives the lender something physical. Customer commitments give it a path to repayment. Put them together, and the AI factory starts behaving like a financeable asset. Now, change the scale. Reuters reported that Nvidia joined 6 financial institutions to create compute financing platforms targeting more than $500 billion. Jensen Huang also described an option, not a promise, to backstop as much as $125 billion, equal to 25% of possible deals. That distinction matters. Arranging capital and guaranteeing it are different businesses. Here is the loop. Investors fund a project loan. The loan builds and equips a powered factory. A long customer promise supports expected payments. Those payments service the debt. Nvidia can help the loop close by coordinating the technical package and, potentially, supporting financing. The factory becomes easier to fund, and durable demand becomes the risk everyone shares. A 20-year promise helps the lender and creates a much longer risk. The danger is another clock mismatch. The infrastructure promise is long. AI economics can change. Models may use compute differently. Customers may renegotiate priorities. Competing systems may become easier to finance. A long contract makes today's demand legible to a bank, but it cannot make tomorrow's demand certain. The easy bullish answer says wealthy buyers can absorb mistakes. Perhaps. A buyer's ability to survive a bad investment does not tell us whether reserved GPUs stay busy or whether the original price holds. Lenders are repaid by customer cash, not by the customer's prestige. The risk stack has several layers. One large customer, unused capacity, changing power economics, construction delays, and alternative compute. Axios argued that Wall Street debt with partial Nvidia backing could both accelerate the build-out and add risk. That is the central trade. Nvidia can unlock more demand by making projects financeable, while moving closer to risks a chip sale once left with the buyer. If the factory works, Nvidia protects accelerator sales and the financing model can repeat. If it disappoints, lenders inspect collateral, customers inspect contracts, and Nvidia's partners inspect any support it offered. The same integration that strengthens the moat can concentrate blame. So the headline capacity number cannot settle the argument. The disclosures must. The final answer hides in who guarantees what not, the headline size. Start with Nvidia's actual financial exposure. Huang described the $125 billion backstop as an option covering up to 25% of possible deals. Future filings must separate an available option from guarantees used, capital invested, or assets owned. That tells us whether Nvidia is coordinating outside money or quietly becoming the risk holder itself. Next, separate reserved, financed, built, energized, and paid capacity. The port's Pike release describes an expected initial 4.25 gigawatts. The better measure later is how much reaches paid use, on schedule, with customer cash arriving. A long reservation may help secure financing. A working factory proves the package can convert promises into output. Now we can answer the opening question. Nvidia's emerging product is a financeable deployment package. The moat is real if Nvidia repeatedly turns site capacity into completed, paying factories while outside capital carries most construction risk. Then its leverage comes from coordinating the whole system. Otherwise, the contract is simply a longer route to the same demand risk. Watch the next disclosures. Does the backstop remain optional? Does expected capacity become energized? And do customer payments arrive without Nvidia taking more risk? That is the scoreboard. Next, watch. The AI that matched 10 years of research in 2 days?